Welcome back to the TD Ameritrade Network with Jay Powell. Tomorrow, and economic data here in the U.S. surprising to the upside. Interest rates are certainly in an odd spot. So let's talk about one of the areas of the market, of course, has been rallying with those low rates, REITs and more. Kevin Kelly is a managing partner at Benchmark. And then we're going to do some trading here with Tom White in studio. Kevin, good to have you back on the show. So let's talk about interest rates. Let's talk Powell tomorrow. The market's now thinking maybe there's no cut in store. What do you think?
Yeah, it's pretty fascinating that it was baked in the cake. And so we've seen that the market has been wrong consistently over the past several years when it comes to the Fed and interest rates, right? So if we go back to a couple of years ago, they anticipated that there were going to be 4 hikes this year. So I think the important thing to note is that while, the market and the Fed funds futures, indicate certain moves, you can't necessarily rely on that. And so over the long term, which everyone should be focused on and not the intermediate term, is that interest rates are, going to stay low for longer. And so that really benefits the real estate industry, because we saw last week and the week before, we saw 10-year treasuries rally so much that it hurt the overall real estate market, going from 1.4% up to 1.8, and they were all sold off, but that didn't necessarily impact their long-term financing.
Now, Kev, this is a really important point, which is for the real estate group, when you've got this low vol trade that many have been piling into this year with the expectations of like infinitely lower rates, the U.S. going to zero, the narrative that's gotten so bearish, but very, bearish on economy, but positive for a lot of these companies that offer dividends and yields. Is the risk to things not being as bad as people think for real estate, for utilities and such?
Well, I'm glad we're talking in a broad-based term, because not all real estate's created equal. So certain segments of the real estate industry are going to do well and certain segments aren't going to do well. So that's why you need to figure out where you're actually positioned. You just can't buy broad-based real estate, because I'll give you a perfect example. One of the best performing sectors is the industrial real estate sector, because it gets you your packages in a day or less, but it's only 7% of V&Q. It's only 7% of IYR. So when you look at the broad-based, you're underweight to the best performing sector. So I would say when you're thinking about this and in a slowing economy, you've got to be positioned to the best sectors that are growing the most, that have the most stability, and ones that, should there be spikes, in interest rates, they can actually weather that.
Let's talk. We're looking at right now one of the sort of tech-focused funds that you've got, SRVR. You've also got INDS. So I want to come back to SRVR. Let's talk INDS, because you bring up sort of the more industrial side and the companies then that have industrial real estate, some of the more, not the way people think about manufacturing, but companies like Prologis, companies like Duke Realty. I mean, walk me through the resilience of this, because INDS has done pretty well even with that yield spike last week.
Yeah, so I'll pick out a name that's really underappreciated in INDS, and that's actually Americold, COLD. It's a highly specialized business because they provide cold storage, right? So if we look at online grocery sales, they're 2% of the overall sales in the United States. Well, that's expected to double, right? But it can't double unless we build out more of these cold storage facilities, because Amazon wants to get you groceries in 2 hours or less, and same with Whole Foods, right? So Walmart. So Walmart upped the war last week, saying, listen, we're going to undercut Amazon on pricing. So I think it's important that people can't underappreciate that entire segment, because having produce at one temperature and then meats at another is really hard to do. And so these are highly specialized business models that are also recession proof, but now they're growing because everybody's consumer expectations have completely changed. Just like people have changed with Netflix, right? I asked somebody the other day, I'm like, do you have Netflix? And it sounded like I was coming off like a jerk, like, how dare you ask that I don't have Netflix, right? So right. It was. I felt actually kind of bad, but it was an honest question. But that's the whole idea here, right? We're going to need the cold storage facilities to be closest to the population, because we want them delivered to us.
Okay. Now let's come back to SRVR real quick, Kev, because when you've got some of the interest rate sensitive real estate, there's this question of what happens if the trend reverses. Let's say the 10-year, in fact, bottomed out last week around the same area it did in 2016. 2016. I remember writing about the buildup in these low vol interest rate sensitive plays in 2016. They kind of unwound without any say or much ado in the market, but this time around there seems to be, and I think you can really measure the amount of leverage that is built up in the market with the expectations being so high that rates just keep going lower. Are they more exposed this time around if indeed that yield bottomed out?
It's actually the complete opposite. So when you look at SRVR, you have to take into consideration that they're growing so rapidly because our voracious demand to connect every single thing on the planet to the internet, right? So we're going to connect our cars to the internet. We're going to connect the refrigerators to the internet. We'll connect saguaro cactuses to the internet to see what their entire habitat and ecosystem and how many animals are they feeding off of that and what are the water levels. So it's important to realize that because every single device is going to be connected to the internet, that it needs to be processed. So there's just too much demand for data centers as well as cell phone towers to process this. We won't have 5G. So I'll give you a perfect example. I would rather rates go up, because rates going up are better for SRVR, because that means the economy is doing exceptionally well, and then our rents are going to go faster than the rate are going to go up faster than the rates going up. Okay. So rising rents matter more than rising rates, and SRVR capitalizes on that.
Hey, one last one, Kev, though, because here's the question. You look at a stock like AMT, all right? It got slammed last week, and while the case for the cash flow versus the interest rate, I can dig that if that's the case and the money makes sense. But for AMT, this has become such a popular momentum trade that now it's gotten wrapped up in this so-called quant quake. So if there's a real rotation to value, is it in trouble?
No, it's not in trouble. It's actually going to present a huge opportunity because it's subject to the vagrancies of the markets. But if you look at what's happening, no AMT, no 5G. And so the important thing to take away from this is that they raised their guidance actually 10 days ago. So find another company that is up this much this year, that is growing revenues, growing the bottom line, growing at 20%, raising their guidance. You can't find that. So I'll give you a quick example, because their competitor, Crown Castle, even came out this year and said, listen, we're not even incorporating any 5G numbers into our financials or our projections. So it's all based on the build out of 4G LTE. So I think, listen, if a quant quake happens and the momentum trade unwounds, you should better take both hands and buy as much as humanly possible.
All right, there we go. All right, Kevin Kelly.
That's the way it is.
All right, well defended, managing partner at Benchmark. Appreciate it, Kevin. Always a pleasure. Let's do some trading here. All right, super bullish, obviously, both hands. Kevin's fund, SRVR, has got AMT in it. How about the stock itself? How would you get long exposure?
Well, it's actually right around its 50-day moving average. It's pulled back about 10%, but still up 37-38% year to date, Oliver. But just to take a look at a simple option strategy, because this is a high-priced stock, $218. I always go to the option market when looking at this. And the first thing, just to back up Kevin's thesis here, if you think it's going to go higher, what I wanted to do is I wanted to go out to the October series. So this is a monthly, or the October 25th weekly series. Expires right before November starts, but they've got earnings after this. So I don't want the earnings in this trade. So what I looked at was buying the 217.5 calls, selling the 225, so lowering my cost entry point on this, paying roughly about $3 debit. You might have to pay a little bit more because the stock's up a little bit today. But you see the break even there, about $220.50 to the upside. Now this captures that upside, $7.50 wide call vertical to the upside. If you pay $3 debit, you get $4.50 in potential reward. And remember, the high on this stock was $242, Oliver. So this is a way to take advantage of a bullish trade, negating earnings, because you maybe don't want that in your play to the upside in case they underperform on that. But this is a way to play it. Simple risk-defined strategy. You know what your downside is going in, and you need this stock above that 220.5 level. But on the other side, Oliver, if you think that maybe it's running out of steam, it's going to run into headwinds around this 218.5 level, which is basically the 50-day moving average.
How would you do the short? Real quick here.
Not really a short, a neutral to bearish trade. And that's doing the 215 put calendar to the downside slightly, so about $3 out of the money to the downside. And you're buying the November 1st weekly series, selling the September 27th weeklies, which expire in about 10 days here. And if you do this 215 put calendar, you're paying roughly about $3.20 debit. You have 4 adjustments plus a closing trade on this because you're selling that near-term option, and you got a break-even risk of about 208 to the downside and about 222 to the upside. So this is neutral to bearish, but you still have a nice wide range for AMT to trade in over the next basically about 45 days or so until that November 1st expiration. But that actually captures earnings, so that'll keep volatility higher. When you're buy-in calendars, Oliver, you want volatility to remain higher in the long option that you bought on the 215 strike. So that's another way to play it, slightly more to the bear side.
You got it, Tom White. Appreciate it. Thanks to Kevin Kelly for Benchmark.